What is an appraisal gap waiver, appraisal gap addendum? What does that mean? We are going to define the vocabulary in this video. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. And today we are talking about appraisal gap addendums, appraisal gap waivers, depending on the vocabulary words a real estate agent might use or a seller might use. Essentially, what they're saying is, buyer, I want you to sign a piece of paper that if the property doesn't appraise for X, you will still move forward. So let's use an example. A $500,000 purchase price. You say, I'll pay $500,000. Seller, the seller says, I want a reassurance that you're not going to walk away if it doesn't appraise for $500,000. And that could be for whatever reason. Maybe there's multiple offers, maybe prices are declining, maybe whatever, right? They just want the peace of mind. What they're saying is, hey, buyer, if it doesn't appraise for, and then you need to put a value in, let's say in this case, $450,000. If it doesn't appraise for at least $450,000, then you have to move forward. I'm going to show you the math, but understanding the definition of vocabulary is super important. So basically, an appraisal gap addendum or appraisal gap waiver says that you will bridge the gap or move forward with your mortgage transaction if the property does not appraise at least at that number or higher. Now, here's the spoiler. You do not have to bring in the entire amount in most instances. This is typically a very small change to your overall monthly payment or cash to close. Let me take you on the screen and I'm going to show you exactly what I mean. So we mentioned a $500,000 purchase price. Let's say we're doing a $400,000 loan. So that is 20%, right? So work with me here if I'm using the math. So in this case, over here on scenario 2, we're still going to purchase it for 500, but what if it only appraised for 450, right? So if we only appraise for 450, what happens? We still have a $400,000 loan. There we go. Now, in this case, we have a 20% loan to value. The amount of the loan, 400, the value at 500. In this case, our loan is 400, but our value is 450. We're still paying the 500,000, but the question would be, how does a lender look at this? What actually happens? Well, 450,000, if you put $45,000 down or 10% down, you'd be at a 405 loan amount. So I'm just going to call this like 11% down. So forgive my lack of math here, but I'm just going to say like 11% down just as a general sense without doing the math. So let's assume in this case, $3,000 for principal and interest. Same. Remember, we got the same loan amount, 400, 400. So same, 3,000. Let's say taxes, $500. Taxes aren't going to change, $500. Insurance, let's call that $200 a month. Again, no matter what it appraised for, that's not going to change. So 200. Here's where the change comes in. At a 20% down or 80% loan to value, you have no mortgage insurance. If you have a 11, 12% down, whatever, maybe now my brain is just making me want to fix this and say, what is a $400,000 loan against a $450,000 loan, right? So 400 divided by 450, 12, 11.2, something like that, right? So, 88.8%, right? So we'll round up to 12 maybe. But with that said, if you have a good credit score, let's say a 780 FICO, the mortgage insurance on a 10% down scenario is probably like $75 a month. I mean, 50 to 100 is probably a good number to kind of put it at. So if you look at it over here, we're at a $3,700 payment. We have a 100K down payment plus closing costs. Here, we're still purchasing for 500. We have a 400K loan. We still have the 100K down payment, right? And we still have some closing costs. Same thing, no matter what they appraise for. But in this case, our payment goes up to $3,775 because we have the added element of mortgage insurance. Now, I want you to answer this question. If you're out there, our payment changed, but did we have to bring in the gap of $50,000? No, we do not. Mortgage insurance picked that up. Now, from a lender standpoint, we are looking at the property worth $450,000, the lesser of the purchase price or appraised value. In this case, we're looking at the purchase price because we don't have an appraised value, right? So your worst case in this scenario, this assumes you have good FICO score. If you don't have a great FICO score, this is a couple $100. It gets considerably more expensive. But your worst case is this plus 75, right? So your worst case, if it comes in 450, 460, 470, 480, 490, your worst case is $75 more per month if you were signing that appraisal gap addendum. That meaning that you're moving forward no matter what. Now, if this $75 takes you over your budget, if this $75 takes you over the underwriting threshold, these are things that you need to individually know and understand, right? So keep that in mind, is that very well could be the difference. But most cases, most borrowers, when I explain this to them, they look at it and go, that's not a big change. Yeah, I thought I'd have to bring in an extra $50,000. No, you do not. Let's do the math. Now, I wanted to show you one more scenario here of how to keep the monthly payment the same and what your cash to close would look like. So in this case, we've got everything the same. Now, in this case, we've got 12% down, 11, 12% down, right? What if we bought out mortgage insurance right up front? We bought it out, we paid for it, but then it gets shifted over to our cash to close. So that might be $3,000 to $4,000, and we could buy out the mortgage insurance. You would never have mortgage insurance because you've already purchased it. So in this case, our monthly payment could stay exactly the same, and our cash to close might go from 100K plus closing costs to say 103, 104K. So we increase our cash to close by $3,000 to $4,000 in this case, but we keep our monthly payment exactly the same. So again, your worst case scenario here is that you're not bringing in $50,000, it's you're bringing in less than $4,000. So that is typically a scenario, again, once I explain it and people better understand it, that could be agents, that could be borrowers, that could be whoever it may be, that typically gives them the peace of mind that they're willing to move forward. Now, let's hope it comes in at 500 and there's no changes at all. Now, let's walk through some of the small print. I'm sure you're going to have it in the comments below. This assumes you get the same interest rate for 20% down that you get for 10% down. That is typically the case. If you go into Fannie Mae LLPA matrix, so this gives you the Fannie Mae loan level pricing adjustments. I want you to see this. I want you to understand that if you have a good credit score and you're putting down 20% versus 20% versus, say 10%, what that looks like. I think I need one other, sorry. Loan limits, AMI, eligibility matrix, LLPA pricing, loan level price adjustment. This adjusts a price. So let's go in there. I think I gave a 20% down at a 780 credit score. So there is an adjustment here if we're putting 20% down of 0.375. if we're only putting 10% down, our rate technically got a little bit better. Yes, we only added a quarter versus 0.375. I know this seems illogical, but I'm proving my own point that you're not getting a worse rate. If you see a 0, that means nothing is added on. Your absolute very best with Fannie Mae is putting 25% down and having a 780 FICO score or higher. This is a purchase money loan on a single family home. If you're doing a condo or something else, there's adjustments across the board, second homes, whatever it may be. But my point here is that there's a 0.375 adjustment to kind of whatever that par rate might be. You're actually getting a better rate, only slightly less, but you're getting a better rate if you're only putting quote unquote 10% down to 15% down than you would otherwise. So put your comments below. I can do a whole video on loan level price adjustments, but I want you to understand what this appraisal gap addendum, appraisal waiver scenario looks like. Now, here is a little bonus tip. If you're putting 5% down, you're putting 3% down, you don't have additional cash to close. You shouldn't be signing one of those. That really means you don't have any room to be able to go from 20% to 10%. You don't have that room to go from 3 to 5% down to 0%. The loans don't exist there for you, right? You don't have a 0% down loan likely. You could be doing USDA, you could be looking at VA. But with that said, most people, if you're putting 3 to 5% down, the math just doesn't math. If you're putting 10% down, maybe there's a slight amount that you could do for an appraisal waiver to still be competitive, right? Or to still get the seller to accept your offer. But you have to consider what your down payment is. So make sure and reach out to a lender to let them help you make sure that math is okay before you go and sign something. If you have questions, you want to reach out, you want to connect, all my contact them below. Make sure and comment. Make sure and click that subscribe if you made it this far in the video. And we'll be in touch for a lot more mortgage, real estate, and interest rate videos in the future. Have a great day.